Everyone, thank you for joining us today for our webinar, the 2014 Tax Update. My name is Laurel Dobbin. I will be your moderator this morning. If you're joining us to receive California CE credit, please note that if you meet the requirements we'll go over in a minute, you'll receive an email within 3 business days with access to your certificate. First, some housekeeping items. Using your webinar pane, you can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. In the pane, you'll see a chat box that you can use to enter your questions, and then just type your question in and click send. Our presenters will try to answer as many questions as possible at the end of the webinar. Those questions that aren't answered, we will follow up with you after the webinar. For your audio settings, in order to ensure good audio quality during the webinar, please make sure you select the appropriate audio mode. If you're using a telephone, click the telephone audio mode, or if you're listening through your computer, please click the mic and speaker option. And also, as a participant today, you will receive a link to download the slide deck and recorded presentation within 72 hours. And now for the California CE credit. If you are asking for credit today, you must use a personal computer, no PDAs, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions and complete the evaluation survey at the end of the webinar. And now I'd like to introduce you to today's presenters. First off, we have Dan Jones, a tax partner here at Armanino. Dan has more than 20 years of experience helping clients identify the best strategies to reduce their tax risks and helps clients understand complicated tax issues. He also identifies the best strategies when planning to take advantage of tax benefits, and he's going to talk about some of those today with you. Joining Dan today is Stephanie Eustace, a tax manager at Armanino. She has more than 10 years of experience helping clients identify the best strategy to reduce their tax risks. She joined Armanino in 2006, and she works on a wide variety of clients, such as closely held businesses and individuals. So welcome to both of our presenters, and I'm now going to go over our learning objectives. During today's webinar, we will review expired tax breaks that Congress may revive later this year. We'll discuss tax saving strategies for business related to R&D, enhanced depreciation, and employee bonuses, and identify how individuals can reduce their tax bills through investments, charitable planning, and more. And with that, I'm going to pass it off to Dan to kind of give it a more detailed overview of the presentation. Dan?
Thank you, Laurel. Today we're going to break this up into 2 parts. We're going to go through some business tax planning strategies that you want to take a look at before year end, and also then individual strategies for year end. We're going to look at, for businesses, some depreciation credits that you can get, and take a look a lot at accounting methods and how that impacts your tax planning. On the individual side, we're going to go briefly over some fraud issues we've been seeing, and along with accelerating some deductions into this year and possibly changing your income recognition as well. First off, though, we're going to just compare this year's current tax landscape to prior years, and Stephanie will give you a brief outline on that.
So as you can see from the slide in front of you, there are fewer provisions scheduled to expire at the end of 2014 versus 2013. The biggest change we're seeing this year, though, is that in 2013, we had more law changes going into effect and some pretty major changes, including the net investment income tax.
Yeah, in the prior few years, there's been large bills that passed, and there's a lot of information to wrap your hands around. This year, not so much. It's more just implementing those law changes and doing some tax strategies now that we're kind of used to these rules.
Okay, and with that, we'll go to our first polling question. Please remember, if you would like CE credit today, you need to answer 75% of these questions. Are you attending the webinar for business, individual, or both updates? A for business, B for individual, or C for both? The votes are coming in. We'll go ahead and close the polls in 3, 2, 1.
So it looks like most people are joining us today to hear about both business and individual updates. That is perfect since we will be covering both. So we'd like to first start out today with our business update. The first topic we wanted to cover is depreciation. In the past few years, depreciation has been a large planning point for most businesses. We wanted to first go over the actual amounts of depreciation allowed for 2014. So for Section 179 depreciation, last year you were able to immediately deduct rather than depreciate up to $500,000 in qualified new assets. The deduction was phased out once you exceeded $2 million of purchases. For 2014, because Congress has failed to extend this election, right now we're looking at limits of only $25,000 and $200,000 respectively. So as you can tell, this is going to be a huge decrease. For bonus depreciation, we're seeing a similar trend. For 2013, you were able to take up to 50% of the qualified asset cost through bonus depreciation. Right now, for 2014, there is no bonus depreciation available.
So that's a big deal. In the past couple of years, we had a lot of clients buying a lot of equipment and taking a big deduction for that. So what should our people consider now that this law is not as valuable?
So the key takeaways right now for depreciation. The first point is that if you need some equipment or another asset, go ahead and purchase it. Don't let the tax laws be your only consideration. You might want to take advantage of at least the $25,000 allowed under Section 179 at a minimum. You can always wait and see if anything changes by the end of the year and be prepared to act quickly if it does, since you must place any assets in service by the end of the year to take advantage of these depreciation deductions.
Yeah, Congress loves to send these things out at the last minute as we get these every year. So, keep your eye out.
So with less depreciation planning available, Dan will now cover some other credits and deductions you might want to consider.
Okay, let's talk a little bit about R&D credits. R&D credits are nothing new. Every year, in fact, it hasn't been permanent. So every year Congress lets it expire and they have to do some legislation to reinstate it. And once again, we're in that situation. In all my years, and I've gone back a few, Congress always does extend this. So you probably most likely will get it extended. But why are we talking about this right now? One thing I've noticed is that a lot of businesses who qualify don't realize it. For instance, contractors can potentially qualify for the R&D credit. The other place is manufacturers. If they are developing their own manufacturing techniques, that possibly qualifies for the R&D credit. So a lot of times you're searching for, you've made income, you're searching for deductions or credits, and this is a place to look just to make sure that maybe you've overlooked that. Now the big change to R&D that makes this easier is that the R&D Alternative Simplified Credit was passed. And why is that important? For the general credit, there's a lot of record keeping you have to keep, and you have to go back potentially 10s to 20s years for that record keeping that you just may not have. So what this new simplified credit does for you is it eliminates a lot of that record keeping, and you can actually go back and amend a tax return in order to get this simplified credit. Generally it's not as good as the regular credit, but that credit is better than zero. One thing to keep in mind too is that if you're going to amend and go back and get the simplified credit, you cannot have taken the credit in the past. So it's not something that is doable if you've taken that credit in the past. So just keep that in mind. Next thing I want to look at is the manufacturer's deduction. Once again, this has been in law for many years, and it was put into place to give you an effective 3% reduction in your tax rate. As you can see, the Section 199, or manufacturer's deduction, is based on your domestic production activities, and it gives you a 9% tax deduction based on those activities. Those are limited to 50% of your W-2 wages, so it doesn't necessarily work if you're a sole proprietor with no earned income. But once again, why are we talking about this? This is another instance where I see a lot of people not knowing they qualify for it. For instance, once again, construction people can possibly qualify for this. Engineering firms, architecture firms, software development, and then some agricultural activity. So it's there for the taking. And for this matter, it's just a matter of looking at your type of business and asking the question, do I get this manufacturer's deduction? Okay, let's touch on some other traditional year-end strategies. The go-to strategy that everyone really points to is trying to defer income and accelerate deductions. So in this case, if we're in 2014, we want to defer income to 2015 and accelerate deductions into 2014. The play there is it's a time value of money. If you pay less tax this year, you're investing that savings in your business or wherever you want to, instead of having the government use it. The other aspect is that you may have a lower tax bracket this year compared to next year, and there's different strategies around that. So you look at tax brackets between years and time value of money. Now your strategies here really change depending on your type of accounting method. For instance, you're either going to be most likely a cash method or an accrual method taxpayer. So Stephanie, why don't you give people some examples of what they can do to defer income and accelerate expenses under the cash method of accounting?
So for a cash method taxpayer, one thing you might want to look at is prepaying any recurring expenses. So recurring expenses would be bonuses, wages, insurance, anything else you're paying vendors for general expenses. One thing to consider, though, is to make sure you're only prepaying up to a year. You cannot pay for 2 years, for example. In terms of income, you might consider billing clients later in the year so that income is realized when it's received.
Now, I have a lot of questions from my clients that say, well, I'm just going to hold that check and I'll deposit it in January or whatever your fiscal year end may be. So why shouldn't they do that?
So technically you need to recognize the income when you receive it. It doesn't matter when you deposit the income. The auditor, if you get audited, the IRS loves to look at bank records from right before year end and right after to make sure that all your deposits look legitimate. So really you just need to concentrate on when the income is received.
Great. So now if you're accrual method taxpayer, let's talk about that a little bit. One of the things that a lot of people do is pay bonuses. And as an accrual method taxpayer, you can actually accrue that bonus in 1 year, pay it in the next, and still get that deduction. Now there's a trap there that you need to be aware of. There's actually two issues there. One, technically, most people close their books, and sometimes in March they say, oh man, I have big income. Well, I'm going to accrue a bonus back to the end of the year and lower my taxable income. Well, this is not technically correct. You really have to determine what that bonus is before year end. The IRS is really looking at this issue as well. So if you end up having big accrued bonuses, you really need to document before end of year how that bonus was determined, who's getting the bonuses, and it's really got to be fixed as of the end of the year. The other piece is, so say you've correctly accrued for that, and then you don't pay it within 2.5 months of the year end. Then you lose that bonus again, and it gets pushed to the next year. So any accrued personal service type expenses need to be paid within 2.5 months of the year end. Now, other expenses, you can potentially pay them even though those expenses have not been earned. For instance, there's an election to deduct your property taxes, even though the property tax period may not have run. So you can look at a few of those elections if you hadn't already made those, and this gives you a good chance to accelerate some of those deductions into this year. From a income deferral standpoint, one thing that a lot of people miss is deferred income on personal services. For instance, if you are performing services that are going to take place over the next year and you require a prepayment from your client or customers, generally either from the cash method or accrual method, once you receive that cash, you have to recognize that income in the year of receipt, even though you haven't necessarily performed those services. Well, you can make an election to, as an accrual method taxpayer, to defer that until you earn that actual income, perform the services. That's when I see a lot of people miss. And we're going to talk about accounting method changes later. This is one area that you may want to change your accounting method. All right, why don't we take a look at those accounting method changes. When I pass that over to Stephanie to give you some examples of that.
So we wanted to talk about accounting method changes next. One thing to note about accounting method changes is that you're not always stuck in the accounting method you're currently using. While some businesses might have less flexibility in the accounting method they can use, others might have options. Certain accounting method changes are automatic and only require documentation to be filed with the tax return. So one example of this would be switching from the cash to the accrual method of accounting. Dan, are there any other examples you can think of?
Yeah, a great example is if you own real estate, especially in a business. If you own a building in your business, there's something called a cost seg study. So generally, if you have a commercial building, you have to depreciate that over 39 years. Well, if you do one of these cost seg studies, architect, engineer comes in and looks at your facility, and they can actually switch some of the 39-year property to 5-year depreciable property, 7, 15, etc. And on a expensive building, and here in California, if you're here, buildings are expensive. That can be a huge tax savings. Now, generally, you'd have to go amend prior years, and you'd get a deduction for the open years. But under the accounting method change, we're actually able to file this accounting method change, recover all the differences, and take that deduction in the year we filed the Form 3115.
So regardless of the type of change you're making, the actual forms you're going to file and the process is going to be similar. So for any change, you would file a Form 3115 with the IRS. A few notes on filing the 3115. You want to make sure you fill out the form completely. Also note there is a fee to file for non-automatic changes. As Dan mentioned, one of the benefits of doing an accounting method change is that if it results in a deduction, you can take it completely in the current year. If there's income, you would actually get to spread it over a number of years. So again, a benefit. We would recommend when you file a Form 3115 that you complete the form and then call and discuss it with the IRS before filing, just to make sure they're on board with your reasoning and they agree.
Yeah, in fact, we had a good example of this. And one thing with tax planning, you want to think of different angles. So we had one client that had a small inventory business. They sold parts. And the other piece of their business was a service business. Well, they were on the accrual method of accounting because generally if you have inventory, you got to be on the accrual method accounting. But in this case, that inventory business was such a small piece of their overall business that we said, hey, let's segregate this and do what's called a modified accrual method. So what we proposed to do was to treat the inventory parts business under the accrual method of accounting and the cash method personal service piece as cash method. And since that's the much larger piece, we were going to have significant savings for the client. So what we did there is, because this is not one of those automatic changes, we actually filled out the form and all the documentation and ran it by the IRS group that is actually in charge of these accounting method changes. So you can actually call them and talk to the people who are going to rule on this. So we kind of felt them out before and was able to tailor our documentation so we had the best chance of it getting approved. And they kind of gave us the wink wink that it probably would be approved based on what we've told them. Since you have to pay money for that, you don't want to get in the situation where you can pay a bunch of large fee and then not get the accounting change done. Another planning point on accounting changes is every year the IRS issues you a revenue procedure on accounting method changes. And it's a good idea just to look at those new ones because they always have new ones, and that may be something that applies to your business. And if you haven't done that in a while, just go through the list of the automatic changes, and you may find that there's a significant savings there for you. So Stephanie, if there's anything else we should talk about for either under accounting method changes or traditional year-end strategies?
Well, we talked a lot about deferring income and accelerating deductions, but just keep in mind that might not always be the best strategy. If you expect your tax rate to increase in the following year, you might be better off accelerating income and deferring deductions to future years. So you really need to know your situation and plan accordingly.
Yeah, that's a good point, because if you just blindly defer income, accelerate deductions, it may be that you know that the next year you're going to have a big income year. And so you're going to be in a lower tax bracket in the current year, higher the next year. So time value money is not going to pay off in that situation. So you really want to tailor your plan to your projected year. So you actually want to look at generally a couple years and project that out that way.
Okay, we're ready for polling question number 2. The question is, can you change your accounting method? A, yes, B, no, C, not sure. And the votes are coming in. We're going to go ahead and close the polls in 3, 2, 1.
So it looks like most people got this one correct. The answer is yes. Just keep in mind that there might be certain situations that apply to you.
Yeah, there's a lot of things you can do for tax planning, and it really conforms to your type of business. Some people recognize income differently than the others. So you really have to tailor any planning to your type of business. Most important thing. So why don't we take a look at some of the individual issues we have.
So the first item we wanted to cover under the individual update is fraud. And while this isn't necessarily a planning point, we wanted to mention it because we're seeing it a lot these days. So there's two types of fraud we've been seeing quite often. The first type is various IRS scams in the form of phone calls and emails. So one thing we want to point out here is that the IRS will always initially contact you through writing. So if you haven't been talking to the IRS, heard from the IRS about an issue, and you suddenly receive a phone call, that should be a big red flag, and you should definitely be cautious and not give them personal information.
Yeah, I've had a number of clients that called me up and said, I just got this weird call from the IRS saying I've committed fraud and that they're going to come and arrest me if I don't call this number. And that obviously, if there hasn't been any previous contact, this is a scam. And it's amazing how many people are getting hit by this.
So the second kind of fraud we've been seeing is identity theft. And we have seen a huge increase in this type of fraud recently. So what's normally happening is that people are using other Social Security numbers to file tax returns early in the filing season, and they're usually doing this to claim false earned income tax credits. So the reason we're hearing about it is now that we're electronically filing so many tax returns, when we file, those tax returns get rejected, and we can tell that it's because of the Social Security number.
Yeah, in fact, IRS has asked from Congress help on these earned income tax credits. So they don't have a mechanism to deal with this. So they're supposed to pay them out within a certain time frame, and it's just impossible to properly reconcile who they're paying out with actual numbers. And so it's actually costing hundreds of millions of dollars in tax a year from these scams. And you'll notice that generally, if you're filing a joint return, husband and wife, they're only filing this return on one of those Social Security numbers. So it's not a joint return. So it could be that the husband Social Security is used or the wife's Social Security is used. And the good and bad piece of the electronic filing is, one, at least we know ahead of time that we get an automatic rejection. And so we know that there's been some fraud. And there's some steps you should take. So what are those, Stephanie?
So the steps we would normally want you to take if you suspect that there's some kind of identity theft going on would be first to complete Form 14039 with the IRS. And what this does is this alerts the IRS that you're having an issue with your ID number. And it kind of puts a red flag on your account so that they're aware. They'll also track this for 2 years. You'd also want to report the incident to the various credit bureaus to protect yourself. And if you're looking for any information, the IRS actually has a ton of information on their website that anyone can access. So that's a good resource as well.
The other issue you want to touch on is the healthcare reform. So this has been coming and coming and coming for a long time. And in 2014, the individual mandate was actually in effect. And so what does that mean to you as an individual? Well, if you have taken subsidies, got advance payments, or you want to get credits against your health insurance that you paid, you're going to need to fill out a form to, one, reconcile your subsidy to what you actually should have had, and also to get the proper amount of credits. You also, if you wanted to file for an exemption from the individual mandate, you're also going to have to fill out a form to let the government know that you're requesting this exemption. And the interesting thing with this is the IRS is now using YouTube and the internet to help you make your way through this. So you check out some YouTube ACA government helpful tips. Now, as most people have proper insurance, the reporting requirements are going to be fairly easy. You're just going to have to check a box. But if you don't have proper insurance, then it's on these year-end forms that you're going to have to fill out and calculate what your penalty is. So once again, if you're doing your own return, go to YouTube, and there's some good information out there that is pretty much simplified. You may have seen a form, Obamacare, going around the internet, but I wouldn't put too much stock in that.
Okay, time for a polling question number 3. Please remember, if you are asking for CE credit for today's webinar, you need to answer 75% of the polling questions. Question number 3, how many types of fraud are we commonly seeing? A1, B2, C3, D4, or E, you're not sure. Votes are coming in. We'll leave the polls open for a little while longer. Also a reminder that within 3 days of this webinar, you will receive access to the slide deck as well as a recording of today's webinar. All right, and we'll go ahead and close the polls in 3, 2, 1.
So it looks like most people got this one correct as well. The correct answer is B, 2. So the 2 types of fraud we covered were the IRS scams and identity theft.
All right, let's take a look at investment planning. Most individuals own stocks, are invested in bank accounts that pay interest. So this is something that's really important to take a look at. Most people know that if you have capital gains that you've realized, you want to try to offset them with capital losses. So generally what you do is it gives you a chance to try to rebalance your portfolio. So if you have gains, take a look at your portfolio, and you want to use your investment advisor if you have one in this situation. It gives you a chance to sell some losers that you've been trying to get rid of. Or you can also sell some of these losses and rebuy them at a later date if you still want to hold those stocks in the future, if you think they're good investments. You can also have the opposite situation where you have sold some losers and you got this big loss. And maybe it's a time to say, you know, I've had gains in this one stock. It's too big of a piece of my portfolio. So maybe I'll sell some of that. I'll recognize a gain, but I'll be able to offset it with the capital loss I've had. So that's kind of been traditional. That's something you should always do with your year-end tax planning. But what makes it even more so important is the new net investment income tax. So what is that? You know, it's not new for 2014. It was in place in 2013. But now is a major piece of your planning. So the net investment income tax was placed as part of the Affordable Care Act pieces of legislation to help pay for the government subsidies for the insurance. So what it essentially does is saying people aren't paying Medicare on unearned type income. So we're going to put this law into place to make that piece taxable, essentially the same as Medicare. So who does it apply to? Anyone with a single taxpayer with a modified adjusted gross income over $200,000, and for joint filers, if you have a modified gross income of over $250,000. So that's when it starts to kick in. And so what are some of the sources that cause you to be taxed? Well, like I said, it's your unearned type of income. So you probably know about interest, dividends, capital gains. The other big unearned income piece is rental real estate. A lot of people own property that they rent out. Some of them are generating income from that. That generally is subject to the 3.8%. The other place where I'm seeing a lot of people is in publicly traded partnerships. That's become a big investment in the prior years. And so those income generated out of that is also going to be subject to the 3.8%. So one thing you want to do, as you can see, is because this is based on your income, that your tax planning should revolve around this. For instance, if you are going to recognize a big capital gain and it throws you over this income level, then not only are you going to be taxed with capital gains, but you're going to be hit with this additional 3.8% tax. So it's even more beneficial to harvest those losses. Now there's an interesting thing on real estate. A lot of people are what are called real estate professionals. Stephanie deals a lot with that. Why don't you give an example of how a real estate professional can try to minimize this tax?
So as Dan mentioned, income from rental activities is subject to the net investment income tax. One thing to note is that that income is normally passive income. As a real estate professional, and that means someone who's in the business of real estate and spending the majority of their time in those activities, once you are a real estate professional, your income from real estate will be exempt from the net investment income tax because it will be considered not passive. There's also an option available to real estate professionals and to some other people to group similar activities and thereby ensuring that that income is not subject to the net investment income tax.
Yeah, so that's a very important point. There's different ways that a real estate professional can have their income be called, earned type income. And some of that is based on hours that you're involved in that activity. And so by grouping, you're able to combine these hours so that you actually qualify for that activity. Another place where we see grouping is important is sometimes we have people that have, say, a S corporation that owns the building that they're in. And that building's held in typically an LLC. And the LLC will charge rent back to the corporation. Well, all things being equal, that LLC's income is going to be subject to the 3.8% tax. So you as the business owner own the LLC, you own the S Corp, and even though combined, you may not have income on that LLC or that property because you pick up income on the LLC, deduction on the corporation. You're stuck paying the 3.8% net investment income tax on that. Well, one thing that you can do is then group those activities, and they'd be considered one, and it actually then gets you out of the 3.8% income tax, additional income tax. So once again, it's really important that you identify your different types of income and see if there's a way to convert your passive type income to earn type income, or let's reduce your total income to get out of that. And sometimes it's just not possible, especially as if you're just a W-2 wage earner and you don't own your own business. Some of these strategies are just harder to implement. All right, let's talk about charitable giving. Most people write a check or donate some clothes to a charity and take a tax deduction, which is a good strategy. You want to be a charitable giver. But one thing people don't think about is potentially donating appreciated assets, particularly stock. So for instance, if you bought a stock that has a big gain in it, if you were to sell that, pay tax on it, and then donate to the charity is getting less of a deduction, or less cash because you had to pay tax on it, and you're getting less of a deduction. So the better option there is to look at actually gifting that stock to the charitable organization, because most charities do not pay income tax. So they could sell the stock, get 100% of the proceeds, and then you, as the donator, can take the full 100% deduction based on its fair market value. There's different limitations here, so you always want to make sure you qualify for those. But in general, look at gifting actual property instead of just cash. Okay, now we're going to take a look at some changes in rates and et cetera. Stephanie will run us through that.
So we wanted to cover some of the different cost of living adjustments that we'll see for 2014 and 2015. So the first area we're going to look at is gift and estate taxes. The unified gift and estate tax exemption is adjusted for inflation, and it goes up to $5.43 million in 2015. So in 2014, it's at $5.34 million. The annual gift tax exclusion will remain at $14,000 for 2015. And this is an item that is only increased in $1,000 increments. So it'll probably be another year or two before we see an increase, since it was increased in 2013.
Yeah, surprisingly, I get a lot of questions about this. One, people ask, is this taxable when you get the gift? And I say no. The person who gives the gift may potentially pay tax on it. Two, you can give this $14,000 to as many people as you want. So it's a limitation on each gift.
Right, and one thing to note on that as well is if you're a married couple, you can each give the same person that $14,000 per year. So the next area is retirement plans. So we've given you a chart with various increases. We wanted to point out a few of these, as there are slight increases in some for 2015. So the first item we wanted to point out is the elective deferrals to 401k, 403b, etc. plans. This will be going up $500 in 2015. So the new limit will be $18,000. Catch-up contributions on these elective deferrals will also be going up $500. So that will be going up from $5,500 up to $6,000. Contributions to IRAs will stay the same at $5,500. And as you can see, there's a few other changes on this chart.
Now, if you're a W-2 person, that's the one thing that it's hard to defer income. This is probably your major way to do that. So you really want to take advantage of any retirement plans that you qualify for. It's a lot of times the number one thing people can do to defer income as an employee.
So the next area is just looking at the actual income tax brackets. And as you can see, there's slight increases for 2015. The major item we wanted to point out here is when you hit the 39.6 bracket, there are some other considerations you need to make sure you're paying attention to. So a couple items. Number one, your capital gains rate will also increase once you're in the highest bracket, and some of your itemized deductions could be phased out. So you really want to be aware of these limits.
Yeah, where we see a lot of this is people that have employee stock options and they're exercising these and getting big payouts. If you're one of those people, then there may be some strategy to maybe not exercise the whole thing and pace that over numerous years, because it's real important to stay under that 39.6% bracket, because not only would some of this exercising may throw you into the higher bracket, being thrown in the higher bracket also means it's taxed at the higher capital gains rate. So that's one planning strategy. Make sure it's smoothed over.
So we also wanted to point out the cost of living adjustments for the alternative minimum tax. We've provided the different brackets here for you.
Yeah, and we haven't touched on this, but in any planning situation, you have to take into account the alternative minimum tax. Great example of this is here in California, one of your major expense items is your state tax. So traditionally, people would prepay that state tax, prepay their property taxes, because they're getting a deduction on their federal tax return for that. So you've gone to all this trouble, prepaid it, you're expecting a lower tax bill, and lo and behold, you're hit by alternative minimum tax. So in this situation, state taxes are not deductible for alternative minimum tax. So even though you went to all this trouble, got a good plan, it didn't work, and you've actually wasted potentially some deductions. So I can't emphasize enough how important it is to consider alternative minimum tax in any planning situations. Alternative minimum tax is so complicated nowadays that it's almost impossible to do it without good tax planning software. So be wary of that.
So one more item we also want to touch on is some of the various education breaks. So two of the credits we wanted to touch on are the American Opportunity Credit, and those adjusted gross income phase-out ranges are going to remain the same for 2015. And the Lifetime Learning Credit will see slight increases. These credits are not that easy to claim for our higher income taxpayers. So we just wanted to throw out there that another way you might consider saving for education is through a 529 plan. And 529 plans can be a great option for higher income taxpayers.
Yeah, as we showed on the earlier slide, you can actually gift up to 5 years of the gift tax exclusion into that plan. So you can get a big chunk of money into one of those 529 plans all at once. 529 plans, if spent for education, any income that was contributed to it will not be taxed. So it's a good deferral of income, permanent deferral of income strategy. And you'd file a gift tax return with your 1040 filing. All right, let's keep an eye on Congress. Right now, Congress is debating whether or not to extend some of these provisions. For instance, there's a big argument going on right now whether or not to extend the R&D and make it permanent. That's also true with the 179 expense. There's people who want to make that permanent as well, along with the bonus depreciation. Congress really wants to get this all done before the lame duck session ends. So right now, what's kind of holding it up is this argument about the permanent versus making a 2-year extension and kind of kicking that down the road. So we'll have to see on that. But hopefully this happens before they go on their winter break. Otherwise, especially for items such as 179 and bonus, if it happens after the end of the year, then you really don't have a planning opportunity to go out and buy equipment this year because you didn't know about it. So we're watching this, and if there's any updates on there, we'll send out an alert to let everyone know what has transpired. But if you're a capital-intensive business, keep an eye out that, and you just may have to, make some assumptions there, which with Congress can be dangerous. All right. I think we'll go to our final polling question now.
Okay. Polling question number 4. When will we find out if certain provisions are being extended? A, in November, B, in December, C, in January, or D, there's no confirmed date as of yet. We'll wait and see. And please remember you can submit questions, and we'll have a few minutes to answer some of those at the end of the webinar. All right, we're going to go ahead and close the polls in 3, 2, 1.
So the correct answer for question 4 was D. We wish we knew when these provisions were going to be extended, if they are. So yeah, you have to wait and see. But we do hope that they're extended sooner rather than later so we can plan for them.
All right, before questions, let's go through what we've covered today. So we talked a little bit about Congress and what they're doing with expiring tax breaks. We went through some business tax strategies, depreciation, employee bonuses, accounting methods. And on individuals, we touched on investment planning, charitable giving, and went through the different gift-giving strategies you have and some of the tax bracket changes. So with that, we're going to leave some time open for questions, and we do have a few coming in now.
Okay, so the first question we're going to answer, I will read it so everyone can hear it. So am I to understand that accrued bonuses for 2014 must be paid before February 15th and not March 15th, 2015? No, actually it is March 15th because you would count January, February, and then the first half of March would be your 2.5 months.
Okay, here's another question. We are switching from cash basis in 2014 to accrual in 2015. Is there anything special we should do to avoid paying unnecessary taxes? Yeah, that's a good question. Number one, presumably you're doing that change because either one, you're forced to, which there's some cases where you have to, or two, you're doing it because it's a better income strategy. So hopefully if you're falling under the second case, it's a better method of accounting for you, that you're doing it because you're going to get a benefit from that. But if you're being forced to switch, so you're a C corporation and you've increased your income, so you're required to be in the accrual method accounting. What you really want to look at is your balance sheet. So it's a good idea to understand what items on your balance sheet are going to accelerate income into 2015. So once you understand that, you may either pay them out earlier, or you just have to be ready for that. And you may want to look at deferring some income or accelerating income into your cash year so that you're not going to get hit big in 2015. So it really depends on why you did it, and generally the balance sheet is the place you start. So you can get help from our firm or any accounting firm with that.
Okay, I think we have time for a couple more questions.
My company doesn't reimburse me for my business expenses. Are these expenses still deductible? So this is a great question. Legitimate business expenses for work you do as an employee would qualify as itemized deductions, but they would be subject to the 2% AGI limitation and not deductible for the alternative minimum tax. So you really are better off being directly reimbursed by your employer in this situation. And there is a recent California case that if you're required to spend money for your employer, they must reimburse it.
Yeah, that case actually is regarding cell phones. And if you as an employer are requiring your employees to have a cell phone, then you're going to be required to reimburse your employees for that business use. So that's it. I think that just hit in August or so, or that ruling came out. So it may be that more and more employers are going to have to reimburse their employees. The other piece on that is that it is deductible as a legitimate business expense. It has to be an itemized deduction. And the bad part of that is that you're almost surely going to be thrown into AMT because of this. And for AMT purposes, unfortunately, those employee business expenses are not deductible. So by far, the best way, and if you're an employer, and you want your happy employees, reimbursement's the best, especially if it's expenses they're required to do. You may find out that via California law, you're going to have to do that anyway. Do we have any other questions?
Let's see, I think we got maybe one more.
I think we have time for one more.
So if I purchase an automobile, can I still take a big depreciation deduction? So depending on the type of vehicle you buy, the rules are a little different. Most normal passenger automobiles would be considered luxury automobiles, and those are normally cars that weigh less than 6,000 pounds and that are not considered trucks or SUVs. So there's certain rules when you do purchase an automobile. For 2014, you would have gotten $3,160 in the first year, and then it changes every year after that. If you do buy a vehicle that's more than 6,000 pounds, you can use that 179 limit of up to $25,000 on that purchase. So that might be one area where you could use that 179 if you wanted to.
Yeah, cars are very important to people. So it's been minimized with the law changes, but you can still get a pretty decent sized deduction for the business use of your automobile. One quick note before we run out of time here is one strategy is if you buy that car at the end of the year, say December 31st. If you use it 100% for business, then you're going to get 100% business deduction in that year. So if you're typically, say, 80%, make sure you don't use it personally at the end of the year, and you can actually increase your deduction there. Be wary if you fall below 50% in the following years, there could be some recapture there. But if you're generally over that, it's a good strategy for year end.
Great. Well, thank you both very much for joining us today and sharing your expertise with everyone. I'd like to thank everyone on the webinar for joining us as well. Please remember, if you want CE credit, there'll be a brief survey at the end of the webinar. We would appreciate your feedback, whether you want the credit or not. That helps us improve and provide webinars that you're interested in the future. The next slide I'm going to show you just really quickly. You'll see the contact information for today's presenters. Dan and Stephanie are happy to answer additional questions. Feel free to reach out to them. And if you did submit a question on the webinar today that we didn't have time to answer, we will follow up with you afterwards and get that information to you. So thank you again for joining us, and we hope you'll attend a Armanino webinar in the near future.